So this is a short video about credit cards and consumer loans. So the entire discussion actually revolves around an open-end credit and a closed-end credit. And the emphasis is on the end, meaning with an open-end credit, you have a credit line that you actually keep using over and over again for multiple years, however long that you have the account open for you. With a closed end, you have a deadline or a maturity where you have to pay the balance of the account and close it. So open end is almost, rolling account, and a closed end, it actually ends or dies at a certain period of time. With an open end credit, you have an account that's open for future transactions. You open the account now, and then you have whatever many period that you want um, to have a transaction. In fact, you could have an account and you never actually use it. Um, so you'll have a credit limit. There will be a maximum amount that you can accumulate as a loan in the account, like a credit card. If you were to have a credit card, you can open an account and then you could just have the account ready for you to make transactions. But you may not spend anything for years, and then you will have a credit limit. After the payment period, you will have a or after transaction period, which we're going to talk in a minute, you will have a about 3 weeks or so that you need to make a payment. That payment can be the entire amount that you spend or some of it, but there will be required minimum payment. And open-end credits require a minimum periodic payment that must be paid within a certain period of time after you spend the loan. And interest accrues on the balance. So it's not about how much money you spend, it's not about how much money you paid, but it is about how much balance you have outstanding in the account that accrues interest that you need to pay. So some of the examples of open-end credit are retail sellers and businesses like Sears and J.C. Penney. You could also have banks issuing open-end credit like Chase. Um, there could be some examples of revolving lines of credit, and these could be unsecured personal loans or home equity credit lines or overdraft protection. So, and we're going to talk about credit card in a minute. So think of it like you actually have an account with a bank, but from this account you can withdraw money. You could borrow money, and it could be referred to as an unsecured personal loan. um, Simply, the bank issues you a loan. It's not a credit card per se, but it works very much like it. But it's much probably um, convenient, and more often than not, they will be a little bit more appealing with respect to cost and interest accruing on the account to have a personal loan account rather than a credit card. But obviously, there are security issues, and credit cards may offer some services. So there's a give and take. The home equity credit line is probably the lowest interest that you would possibly pay, simply because you will be having an account where you can withdraw money as a loan, but you're actually putting up your house as a collateral, or your car as a collateral, or you're putting up some sort of a collateral, which makes the credit line more secure for the bank. So they're going to charge you less interest. Um, some checking accounts offer overdraft protections. This is actually referred to as a loan because if you're spending more money than you have and the bank actually pays for you as an overdraft protection, they're actually giving you a loan. So this loan is referred to overdraft protection. That's a very expensive loan. A lot of the times you're going to have to pay a fee and interest. For instance, in my experience, if it ever happens, I would probably have to pay about $40 to my financial institution. That I actually read it right before this video, and it was $40 penalty that I have to pay, and then I also have to pay the interest. And interest was somewhere around 24% a year. So that's actually quite an expensive loan. And obviously, the topic of the day is the credit card. So with a credit card, you're going to have a statement date and then payment due date, and then transaction and posting dates and previous unpaid balance will be what your interest is based on. So think of it like this. Let's say at the beginning of the month, and each credit card may have different spending dates, and all of these dates may be different and specific to a card. But let's say that we actually started out the month, the first of the month starts your um, payment period, and then you have about 30 days, about 4 weeks to spend your loan or your transactions. But again, these all these periods and these dates may depend on the bank, and they may be different from one card to the other. But in my experience, you actually start at the beginning of the month, and then you have about 3 to 4 weeks of a spending period. Now, there's a specific cutoff date, which is referred to as your statement date. So say 24th or the 25th or whatever the date that you agreed when you applied for the credit, they're going to cut your transaction period. From that point on, depending on the bank, depending on the card, you might actually have 2 weeks or 3 weeks to make a payment. Now, in this period of time, you're gonna receive a statement, and the statement will tell you what the minimum amount that you need to pay. You don't pay that minimum amount, you're going to be on default, and that will be reported to the credit agency. And the bank may call the entire loan, and or they may actually charge you a huge fee, and your interest could actually go sky high. So once you make that minimum payment, that's fine. But we'll talk about a minimum payment trap in a minute. If you make a payment and pay the whole thing, the entire spending of the month, then that's it. You're off the hook, and there's no other payments that you would make, and you wouldn't accrue any interest. And whatever you spend in that month, you paid it within that statement or payment due date, and then that's it. You basically don't pay any interest, but you only make the minimum payment, and then you leave the rest of the balance and then go into the next month, then you start accruing interest on the outstanding balance. So be careful about the transaction posting dates. Transaction date may not be necessarily the posting date. And in fact, with respect to the payment, that's very important because your payment date and the posting dates may not be the same. And if you have a payment due date, your transaction date, if you make a payment on the payment due date, it may not be the posting date, and therefore you may look like you actually paid it after the deadline, and there's nothing you can do about it. So it's very smart idea to pay before the payment due date and making sure that you actually catch your payment due date with respect to the posting dates. And any unpaid balance will accrue interest. So the interest will accrue on the outstanding balance after the payment due date. So the minimum payment trap refers to this. Let's say within a month you spend about $1,000. You're going to receive a statement that says you owe them $25 minimum, or $40 or $50, depending on the credit card. They give you an X amount of dollars that you need to pay. If you actually pay that amount does not even correspond to the interest that you're supposed to pay. So it just simply says that you're committed to pay, but you really are not paying anything down in your own spendings on the principal. So if you just keep paying the minimum payment, you could actually keep paying that for 10, 20, depending on the bank, depending on the credit card, but many years, at least a decade, just to pay that $1,000 off. And then all you will be paying would be the interest. Remember, interest accrues on the outstanding balance. So if the outstanding balance interest that accrues on the outstanding balance is more than the minimum payment, then you're not even paying anything down. So the minimum payment trap refers to the banks or the financial institutions letting you having a feel that as if you are paying something towards your credit card, where you really are just paying something to the bank, um, but you're not really paying down neither the interest nor the principal. So, with respect to the credit cards, there is a service that they offer. They limit your liability for fraud, but you have to be very careful with this. There are several catches with this. The first catch is you need to report the fraud almost immediately. Depending on the bank, depending on the credit card. Um, some of them may say if you report to them within 2 days, you're not liable. But um, I would say that if you actually can report anything immediately, it would be great. So the way it works, for instance, with me, is that I've actually selected all the alerts in my credit card, and then anytime a transaction goes through, I get a message. I get an email, I get a message, and I get all sorts of alerts. So these alerts are very, very important because once you get an alert and you don't recognize the payment, now you can actually call your bank immediately and tell them you don't recognize that payment, and then that's it. A lot of the times that will be sufficient and you wouldn't be liable for it. But then again, it depends on the bank, it depends on the credit card. So be careful about who you get your credit card with and then which bank you go with, and then just don't go with the cheapest one just because it's the cheapest. Try to choose a little more reputable national or, if possible, international company. So the liability for fraud, you may have insurance through the financial institution who issued the credit card. You may also have a insurance through Visa or the MasterCard, which are independent companies. So those little logos that you see on the credit card that says Visa or a MasterCard, they are independent companies and they may offer you an additional insurance above and beyond the financial institution through which you obtain the credit card. But what's really important is that you understand the the time period that you catch the fraud and report to the bank may be what gets you off the hook. If you don't catch it on time, and if you wait, days and days until your statement arrives, and then you go through your statement, and then you say, "Wait a minute, there's a problem here," and then you call your bank, it may be too late, and you may be liable for that payment. So it is really a good idea to check your transactions almost daily, and then have those alerts so that anytime a transaction that you don't recognize goes through, you can actually stop payment. Correcting errors is up to you. The financial institutions will simply charge your account and then leave it at that. They expect you to pay. So you need to go through your statements, and then you need to go each and every item to make sure what you actually spent is what is reported, what is posted, and then go through. And now a lot of issues may arise from uncertain payments. For instance, you go to a restaurant, you spent the money, and then you leave a tip. So let's say you had a $40 bill, and then you wrote a 20% tip, so $48. And then all of a sudden, you don't pay attention within the next couple of days, but your statement arrives and you see, somebody put a one in front of it. So instead of a 68, you're now liable to pay 168. Now again, you catch it next couple of days, you may be off the hook. You catch it with this statement, it may be too late. So you need to pay attention to your statement, your transactions on a daily basis, and correcting errors. The burden of correcting errors is on to you. The financial institutions may simply say you're liable to pay this and then send you a bill. Some banks will actually require you to make a payment before you file a claim. So let's say somebody used your credit card and you had a high limit, say $5,000, and then the transaction was for $5,000. It got approved, but it's a fraudulent transaction. Some banks may require you to pay that $5,000 first and then make a claim, and that would be quite outrageous, but some do. So it may not be a good idea to have a credit card that has a significant high limit. It may be better to have a couple of credit cards that have lower limits. So instead of having one $5,000 card, you may want to have, three with $1,500 each, kind of like. So, and then you could have one that you use in your daily transactions and have less than $1,000, just, pay for coffee, pay for things, and so on and so forth. And then, try to change that credit card number every once in a while, just in case. So, with respect to the closed end credit, we'll discuss this a bit more next week. But the consumer installment loans refer to banks lending money to their customers directly. So this is not like a credit card. These are closed end, which means that you actually borrow, say, $10,000, for home improvement or for some other reason, and then you have a deadline. You need to pay it in 6 months. You need to pay it back in a year. So you have a deadline. So sales finance companies can lend money to purchases of products. You bought furniture, the furniture company actually may give you a consumer installment loan. Consumer finance companies can make small cash loans as well. So these could be like payday loans, mm, that sort of thing. So the closed down credit, some examples will be single payment loans, which you make a payment all the way in the back, meaning on the deadline, on the maturity date, but you actually make a single payment. So you borrow $10,000 today, and a year later you pay it back. Or it could be an installment loan. You borrow $10,000 today, and then each month you pay a fraction of it. And then by the time it's 1 year, you will actually pay almost all of it, and then you make the last payment, and then that's it. So the single payment, you make a single payback at the end. Installment, you actually pay in single on multiple payments through an installment. So unsecured versus secured. Some of the closed-end credits may be secured, meaning, like for instance, you could have a collateral, your house, your car. Um, a pawn shop could actually give you a collateralized loan. Your watch, your ring, and that sort of thing. An unsecured simply means that you have no collateral, and a secured means that you actually have a collateral. Um, Whenever you have a collateral, you usually get a little bit more favorable conditions, like a lower interest, longer maturity, more money, that sort of thing. Um, there are two types of interest rates when we're talking about the closed-end credit: the variable rate and a fixed rate. So a variable rate simply means that while you have the loan, the interest rate may change. Now it may change favorably to you or against you. Interest rate may go up, so you may have to pay more. Interest rates may go down, so you may have to pay less. But it is a significant risk that you're taking by accepting a variable rate loan simply because you may end up actually paying a lot more than you actually bargained for. Fixed interest rate loans, you basically sign up today, you have your loan, and you actually have a fixed interest rate, and you know what you're going to pay. So depending on which company you're dealing with, they may actually push you in one or the other, but you have to decide what's best for you. I personally have never gone with a variable rate loan. I want to know what I'm going to pay, so I always went with a fixed rate loan. But different people have different preferences. So some of the high price loans for closed-end credit are payday lenders. These are very, very expensive loans. If you could avoid it, that would be great. Rent to own programs, you rent furniture or a TV and that sort of thing, and then after a while you own it, and they're usually very expensive as well. Obviously, when you don't have the money and you just need to rent, maybe rent to own may be a better, at least at the end you own the product or the merchandise. Pawn shops can be quite expensive, and they may actually charge you fees, commissions, and then you may not get the value of the collateral you're leaving, and it might actually become very, very costly. And then some secured credit cards. Some card companies may tell you that in order for you to receive a credit card, you need to make a deposit. Now, these actually may not be as bad as they sound. If you are trying to create a credit history, which we're going to talk in later weeks, these may be a good way to start. But you should note that these are very expensive. So you are paying for a service, and you shouldn't be going with a too high of a credit card limit because you're going to be paying very high interest. So more money that you ask, more interest you're going to end up paying, and more fees you're going to end up paying. So they all serve some purpose, but you should know that these are usually considered to be very high price loans. So that's all I have for the credit cards and consumer loans. And thank you for watching, and let me know if you have any questions. Thank you.